Hello, I'm John A.G., and before we talk about prices, charts, or predictions, I want you to sit with an uncomfortable thought. Markets don't usually warn you before they change. They don't ring a bell or send a notice saying something fundamental is breaking. What they do instead is behave strangely for a long time. Prices stop making sense. Data contradicts itself. Actions no longer match explanations. And most people don't notice because nothing looks dramatic enough to demand attention. That's exactly where we are right now in the silver market. What's happening isn't loud, it's quiet, it's technical, and it's easy to dismiss if you're only looking at surface-level narratives. The reason I'm talking about it now isn't because I think the system collapses tomorrow. It's because the structure underneath silver pricing is under more stress than at any point in recent memory, and the way that stress is being managed tells you far more about where this could eventually lead than any headline ever will. I didn't rush into this analysis. In fact, I hesitated because early commentary often does more harm than good, but what finally pushed me was the quality of discussion surrounding recent events. On one side, you have people declaring imminent catastrophe, promising explosive price moves and instant system failure. On the other, you have institutional commentary acting as if recent developments are routine, manageable, and ultimately irrelevant. Both positions avoid the harder truth. The real story isn't collapse or calm, it's strain, and strain matters. To understand that strain, you have to understand how silver is actually priced. The price you see quoted globally is not the result of people exchanging physical silver in real time. It is largely determined by futures trading on exchanges like the COMEX in New York and the LBMA in London. These markets trade contracts that represent silver, not the metal itself. Most of these contracts are never meant to result in physical delivery. They exist to hedge risk, speculate on price movement, or manage exposure. At expiration, nearly all are settled in cash. Dollars move. Metal does not. This system functions smoothly as long as participants are content with paper settlement. The issue arises when enough participants decide they want the physical metal instead. Futures contracts allow for that option. If a contract holder chooses not to roll or cash settle, they can stand for delivery and request actual silver. The exchange is then obligated to provide it under the terms of its own rules. This is where theory meets reality. According to current data, the COMEX holds just over 100 million ounces of silver in its registered category. Registered silver is the portion of inventory that is specifically available to meet delivery obligations. There is a much larger amount of silver categorized as eligible, totaling several hundred million ounces. But eligible silver is not automatically available for delivery. It belongs to banks, funds, and other entities, and it can only be moved into registered status if those owners choose to make it available. That choice is neither guaranteed nor immediate. Now consider the March silver contract. March is historically the largest delivery month of the year. The current open interest in that contract represents claims on more than 400 million ounces of silver. That's roughly 4 times the amount of registered inventory currently available. This doesn't mean all those contracts will demand delivery, but it does mean the system depends heavily on the assumption that most participants will accept cash instead of metal. That assumption is the foundation of the paper market. When people talk about potential failure, they often misuse legal terms. This would not be a force majeure event. Force majeure refers to unforeseeable disruptions like natural disasters or wars. A system designed with far more paper claims than physical backing is not unforeseeable. It is intentional. If physical demand exceeds deliverable supply, that's not an act of God. It's exposure. That said, a dramatic official default is still unlikely. Exchanges are not passive entities. They have tools designed to protect the system. History shows this clearly. In 1980, when silver prices surged, exchanges changed the rules to restrict buying and force liquidation, effectively ending the rally. In more recent episodes, margin requirements were raised sharply, forcing leveraged traders to either add capital or exit positions. These actions don't fix imbalances, but they reduce pressure and buy time. If delivery demand exceeds registered supply, the most likely outcome is cash settlement. The contracts allow for it. From a legal standpoint, obligations are met. But from a credibility standpoint, something changes permanently. Once participants realize that paper claims can be satisfied with cash, even when physical delivery was expected, confidence in what those contracts represent begins to erode. Trust is the invisible pillar holding this system together. If enough participants start questioning whether metal is actually available, behavior shifts. Institutions become more cautious. Industrial users seek alternative supply arrangements. Large buyers move off exchange. Over time, liquidity migrates. Price discovery weakens. None of this requires panic. It happens quietly. What makes the current situation different from past stress events is the behavior already visible in the physical market. January, typically a slow month, saw nearly 50 million ounces of silver leave COMEX vaults. That's more than 4 times the amount withdrawn during the same period the previous year. Early February continued this trend, putting the pace of deliveries far above historical norms. This is not random variation. It reflects a growing preference for possession over promise. At the same time, the gap between paper prices and physical prices has widened. Buyers seeking coins or bars are paying substantial premiums over spot, sometimes exceeding 20%. That divergence is meaningful. It tells you the quoted price is no longer fully capturing real-world availability. Paper markets can influence price, but they cannot manufacture metal. This brings us to recent price action, which appears contradictory on the surface. Silver experienced a sharp decline even as physical demand surged and inventories fell rapidly. That outcome makes little sense if you assume price reflects physical supply and demand. It makes far more sense if you recognize that paper positioning, leverage, and institutional interests dominate short-term price behavior. We know large short positions existed. We know margin requirements were raised. We know leveraged longs were forced to liquidate. And we know sudden waves of paper selling can overwhelm physical fundamentals in the short term. Whether this was coordinated or simply opportunistic is less important than the fact that the system allows it, and the result aligns with that structure. The more important question is this: who benefits from lower prices heading into a major delivery month? Who benefits from discouraging physical accumulation while inventories are draining? And who benefits from preserving confidence in a paper-based pricing mechanism just a little longer? You don't need dramatic answers. You just need to watch what happens next. To understand why physical demand is accelerating now, you have to step back from silver itself and look at what large institutions and governments are doing with risk. Markets don't move in isolation. They respond to incentives, confidence, and long-term positioning decisions that often have nothing to do with short-term price movements. What we're seeing in silver is not a standalone anomaly. It's a symptom of deeper changes happening across the global financial system. Recently, U.S. officials have pointed to China when discussing volatility in precious metals, framing recent moves as speculative excess spilling over from Chinese markets. That explanation is convenient but incomplete. It avoids addressing the more important question, which is why China and other nations are systematically reducing reliance on dollar-based assets while increasing exposure to hard assets. This is not emotional behavior, it's calculated. Chinese financial regulators have instructed domestic banks to limit their purchases of U.S. treasuries. Institutions with heavy exposure are being encouraged to gradually reduce those positions. Official statements describe this as diversification, not distrust. But diversification away from the world's dominant reserve asset is not a neutral act. It signals a reassessment of long-term risk. At the same time, China's central bank has continued adding gold to its reserves month after month. This is not tactical buying, it's policy. Central banks don't accumulate gold because they expect quick profits. They accumulate it because gold carries no counterparty risk. It cannot be sanctioned, frozen, or diluted. It exists outside the credit system. When a central bank steadily increases gold reserves while reducing exposure to another country's debt, it's positioning for a future where trust in paper promises may be tested. Statements from Chinese leadership about promoting the yuan as a global reserve currency add further context. Reserve currencies require more than trade volume. They require credibility. That credibility is built through stability, liquidity, and confidence in long-term purchasing power. While modern reserve currencies are not formally backed by gold, the presence of large gold reserves still matters. It supports perception, and perception drives behavior. Silver fits into this picture in a unique way. Unlike gold, silver is both a monetary asset and an industrial input. It is essential for electronics, medical devices, energy infrastructure, and solar technology. Much of the silver used in industry is consumed permanently. It is not efficiently recycled. That makes supply tighter over time, especially as industrial demand grows. This dual role means silver is sensitive to both monetary and industrial shifts. When confidence in fiat systems weakens, monetary demand rises. When energy and technology investment expands, industrial demand rises. When both happen at the same time, pressure builds quickly. The market structure is not designed to handle sustained physical demand from multiple fronts without stress. Western vaults are already reflecting this pressure. Metal is leaving not because of panic, but because incentives have changed. If you're an industrial buyer, relying on spot availability during a stressed period introduces unacceptable risk. If you're a large holder of paper claims, watching inventories fall while premiums rise creates uncertainty. Rational actors respond to uncertainty by securing supply early and reducing dependence on intermediaries. Meanwhile, macroeconomic conditions are shifting in ways that historically support hard assets. Employment data has softened. Revisions suggest job growth was overstated previously. Inflation metrics are easing, with core measures slowing toward levels not seen in years. These developments increase the probability of monetary easing. Even cautious central bank officials have begun acknowledging that additional rate cuts may be necessary if economic weakness persists. Markets don't wait for certainty, they price expectations. As expectations for easier policy grow, the opportunity cost of holding non-yielding assets declines. This doesn't guarantee immediate price increases, but it changes the backdrop. It also reinforces concerns about long-term currency stability in a world where debt levels remain elevated and fiscal discipline remains weak. This is where the structural fragility of the modern monetary system becomes relevant. Fiat currencies are backed by confidence, not convertibility. For decades, governments have expanded debt and monetary support to manage crises, normalize deficits, and smooth economic cycles. That approach worked as long as confidence held and alternatives were limited. What we're witnessing now is not collapse, it's repositioning. Central banks are hedging, institutions are diversifying, physical buyers are acting earlier in supply chains. None of this requires an imminent crisis to be rational. It reflects a recognition that the margin for error is shrinking. When systems rely on confidence, even small cracks matter. Silver sits directly at the intersection of these forces. It is undervalued relative to gold by historical measures. It is essential to modern industry, and it trades in a market where paper claims vastly exceed deliverable supply. As more participants prioritize certainty over convenience, physical pressure builds quietly beneath paper pricing. This does not mean the exchange fails tomorrow. It means stress accumulates. The tools available to manage that stress can delay outcomes, but they cannot resolve fundamental mismatches. Cash settlement satisfies contracts but does not replace missing metal. Rule changes manage behavior but cannot restore trust once it erodes. As the delivery cycle progresses, the most important signals will not be dramatic announcements. They will be subtle. Delivery volumes, inventory flows, premium behavior. These indicators reveal more than price ever could. Elevated premiums alongside falling prices signal tight physical supply masked by paper pressure. The silver market is currently being pulled in two directions. Paper mechanisms still dominate short-term price discovery. Physical realities increasingly dominate long-term positioning. When those forces diverge, volatility increases. Resolution comes later, often after patience runs out and assumptions are reevaluated. The mistake many observers make is focusing exclusively on price movements. Price is visible, but it is often the least informative signal in distorted markets. Quantity, flow, and behavior matter more. Who takes delivery? Who pays premiums? Who delays purchases? Who doesn't? We are not witnessing a singular event. We are watching a process unfold. And processes don't announce themselves. They reveal themselves slowly through behavior that only makes sense in hindsight. That process is now underway. As this situation continues to unfold, the most important thing to keep in mind is that markets rarely fail in obvious ways. They adjust first, they bend, they search for mechanisms that allow them to keep functioning even when underlying assumptions no longer hold. That's why focusing on whether the system survives the next delivery month misses the deeper issue. Survival does not mean stability. It simply means the framework is still standing, not that it remains sound. The COMEX has navigated periods of stress before, and it will likely navigate this one as well, at least formally. Trades will clear. Contracts will be honored, either through metal or cash. Warehouses will report inventory. On the surface, everything will look orderly. But beneath that surface, behavior will continue to change, and behavior is where structural shifts begin. Markets evolve not when rules are broken, but when participants stop believing the rules reflect reality. This is why the idea of a single dramatic breaking point is misleading. There will probably never be a moment where an official announcement confirms that the paper-silver market has lost credibility. Instead, credibility erodes quietly. Large buyers begin sourcing metal privately. Industrial users lock in supply earlier. Institutions reduce exposure to delivery risk. Liquidity slowly migrates. The system continues operating, but it no longer commands the same trust. For individual observers, this creates confusion. Price movements suggest one thing. Physical conditions suggest another. When paper markets dominate short-term pricing, those signals can diverge for extended periods. This does not mean one side is wrong. It means they are operating on different timelines. Paper reacts instantly. Physical adjusts slowly. Understanding the difference is essential. It's also important to understand that awareness alone does not force immediate change. Many participants already understand that paper claims far exceed physical availability. That fact has existed for years. What changes outcomes is not awareness, but incentive. When incentives shift, behavior follows. Right now, incentives are shifting toward control, certainty, and possession, especially among participants who cannot afford supply disruptions. That does not mean reckless action is warranted. In fact, reacting emotionally to structural stress often leads to poor decisions. The COMEX and similar institutions have tools that allow them to manage pressure far longer than most expect. Margin adjustments, rule interpretations, and cash settlement provisions can delay consequences. These tools do not resolve imbalances, but they stretch timelines. Anyone positioning based solely on an imminent breakdown is speculating, not managing risk. A more useful way to think about silver in this environment is as a form of insurance, rather than a vehicle for rapid gains. Insurance is held not because disaster is guaranteed, but because the cost of being unprepared can be severe. Physical metal serves that role in a system where many financial assets rely on layers of trust, leverage, and counterparties. The trade-off is cost, inconvenience, and patience. The benefit is optionality if confidence weakens. Paper exposure offers a different trade-off. It provides liquidity and ease of access, but it keeps you tied to the very structure you may be questioning. Mining equities offer leverage to price movements, but introduce operational, regulatory, and geopolitical risks. Derivatives magnify outcomes in both directions. None of these approaches are inherently wrong. They simply serve different objectives. Problems arise when expectations and tools are mismatched. Long-term structural concerns paired with short-term leveraged instruments create unnecessary risk. Short-term trading framed as long-term conviction leads to frustration. Clarity about purpose matters more than conviction about outcomes. Looking forward, the signals worth monitoring remain subtle. Delivery data around first notice day will indicate whether demand is accelerating or being deferred. Inventory reports will show whether registered stocks continue to decline or stabilize. Physical premiums will provide insight into real supply conditions. Central bank behavior will reveal whether accumulation trends persist. None of these signals require prediction. They require attention. The dollar remains central to this narrative. Commodities are priced in dollars, and dollar strength or weakness influences nominal prices. But the deeper issue is not daily currency moves. It is the evolving role of the dollar itself. Even modest shifts in reserve preferences can have meaningful effects on asset flows. These shifts do not happen quickly, but once underway, they are difficult to reverse. History shows that reserve currency transitions are slow and uneven. They unfold over decades, not months. During these transitions, volatility increases, and old assumptions lose reliability. Silver, sitting at the intersection of monetary and industrial demand, becomes particularly sensitive during such periods. Another misconception worth addressing is the belief that markets must be fair to function. They do not. Markets function based on incentives, power structures, and rules. Fairness is subjective. Participants adapt to whatever framework exists. Complaining about manipulation without adjusting strategy accomplishes nothing. Understanding the framework allows you to operate more intelligently within it. Emotional reactions are especially costly in environments like this. Fear leads to rushed decisions. Optimism leads to overexposure. Both ignore the reality that markets are complex, adaptive systems. Interventions create unintended consequences. Attempts to suppress volatility often amplify it later. The most durable approach is humility and flexibility. What we are witnessing in silver is not an isolated anomaly. It is a demonstration of how paper abstractions interact with physical constraints. It shows how confidence can persist long after fundamentals weaken. It shows how institutions protect systems that benefit them, and it shows how quietly those systems begin to change when incentives shift. The most valuable takeaway is not a price target or a forecast. It is a framework. Pay attention to flows rather than narratives. Observe actions rather than statements. Separate short-term price behavior from long-term structural trends. Avoid binary thinking. Markets rarely move from functional to broken in a straight line. If the paper precious metals market eventually loses credibility, price discovery will not vanish. It will migrate. It may move toward exchanges with stricter physical settlement. It may shift toward direct agreements between producers and consumers. It may fragment into regional pricing structures. None of these outcomes require chaos. They require adaptation. The real question is preparedness. Preparation does not mean betting everything on one outcome. It means reducing reliance on assumptions that may not hold indefinitely. It means diversifying strategies, not just assets. It means accepting uncertainty rather than demanding certainty before acting. Silver's role in that preparation depends on individual circumstances. For some, it is a hedge. For others, it is a trade. For others, it is a raw material essential to production. The market can accommodate all of these roles, but tension arises when a single paper structure tries to serve them all simultaneously. We are not at the conclusion of this story. We are in the middle of a transition. Signals are mixed because transitions are inherently messy, but the direction of pressure is clear. Physical reality is asserting itself more forcefully against paper representation. This process is gradual, uneven, and often invisible until hindsight clarifies it. Waiting for certainty is a mistake. Certainty arrives only after opportunity passes. The goal is not to predict the precise moment something breaks. It is to recognize when assumptions are weakening and adjust accordingly. That is not fear, it is discipline. In the months ahead, silver will continue to test patience. Prices will move in ways that frustrate conviction on both sides. Commentary will swing between complacency and alarm. Beneath it all, the underlying dynamics will continue playing out quietly, one delivery request, one inventory report, one policy decision at a time. Understanding that process matters more than any single outcome. That's where I'll leave it.